Hey guys, Whitney here. Welcome. It's Tuesday afternoon. Whoops. I'm going to give everybody just a minute to get filed in the room before we get started today. Anyways, if this is your first time joining, welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. And today we are going to tackle the topic of the fees of passive real estate. Now, before we dive in, again, if you don't know me, welcome. I actually, what I do is I invest in passive real estate. My husband and I personally have acquired a portfolio of over 6,500 multifamily units, 2,200 self-storage units. But I didn't start off in real estate. That's not what I went to school for. So that's why I do this weekly podcast and masterclass to really help you as a limited partner investor understand the ins and outs of passive real estate and how to go into your first and next deal with confidence, because that was the same position that I used to be in several years ago, and all of this education did not exist. So I'm here to help you kind of see through the noise, understand different terms, and how to put all that knowledge into use. Now, this is just a snapshot of our current personal portfolio numbers, but really what that's allowed us to do is get 100% control on how we and choice, I should say, on how we invest our time. And I love spending my time here with you guys. And we can actually help you achieve, scale, and build a similar portfolio, achieve those results of having financial freedom, time freedom, location freedom, freedom of just what kind of impact you want to make in the world. And these are just a few of our key metrics here at passiveinvesting.com. We have acquired over 1.3 billion in assets, and we have very strong returns to our limited partner investors. Now, we are going to talk about fees of real estate today. And I don't see us getting into any typical financial advice, legal advice, or tax advice, but if we do touch on that during today's talk and presentation, or in the Ask Me Anything portion of today's session, if you're here live, make sure you take anything that could be construed as that type of advice, and make sure you understand how it applies to you. And so consult your team before investing. All right. So let's first take a look at what fees should do for you, because I think this is a really, I think it's a great question that a limited partner investor should be asking of any operator when they're interviewing an operator, but we should also be asking what fees are there for this deal when we go into a deal. Now, here's the thing. You can't avoid having zero fees within a deal. But what the fees should do, what fees are being charged, one, they should be 100% transparent. You should either be able to ask the operator and they give you a straight shooting answer on what fees are going to be charged, what and when, and how those funds are going to be utilized. Two, they need to create some sort of alignment between performance and the ability to charge that type of fee. And they should still be able to allow you as a limited partner investor to reap a good return. Now, one of the things that I am very passionate about when I look at any deal that I'm going to go into is that I want to see a pro forma, a projection of returns that is net of all fees that could possibly be charged in that asset. Okay, I don't want to do any sort of mental gymnastics. I don't know if you've ever taken a look at the prospectus, say like you're in stocks, bonds, and mutual funds. If you've taken a look at a prospectus, which is essentially a pro forma, of that particular stock, bond, mutual fund asset, that prospectus, I would bet you largely those fees are, you have to do the mental gymnastics to figure out what your return is going to be. So again, we want the deal to be able to still yield a good solid return, depending on what your goals are, cash flow, equity, right? Or some sort of blend of both. And you be able to fully understand what your net return should be, or at least that range of net return based on the sensitivity analysis. And again, top thing is that it has to be, those fees need to be disclosed and transparent. Now, oftentimes when you go into a limited partner deal, when you're looking at a deal, you might just have the offering memorandum to review. And, sometimes you'll see the fees listed in there, sometimes you won't, because maybe the general partnership is still working out the PPM or the legal documentation on the back end. But regardless, you need to be able to ask that operator what the fees are and make sure they are documented in the legal paperwork, that PPM and subscription agreement, before you hand over a check. All right, so let's talk about what fees are there. Okay, we talked about what fees allow, should do for you, right? Create that alignment. They need to be transparent. The fees on the general partner side actually allows them to, continue to source new deals for you, complete all the due diligence on those deals, put down earnest money on that deal and future deals, do the inspection, put down any, do environmental. Those fees actually, some of these fees actually reimburse the general partnership for their actual time, effort, and contracts that they've already honored in order to get that deal up and running. Also, those fees will help the general partnership to keep the lights on, to perform asset management on your behalf going forward, to perform capital events on your behalf going forward. Now let's talk about exactly what fees there are and what kind of a typical range in this private real estate, private equity space. So one fee that you can, potentially, expect to encounter is what we call an acquisition fee. And again, this fee might be 1% to 3% of the purchase price. It really allows the general partnership to go out and source deals, right? For them to, hire a team, to do a great deal underwriting, to go out and walk the property. It covers that type of expense. It might reimburse back for any money they had to put up for earnest money deposit to get the deal moving through, or cover inspection, because sometimes inspections can cost, $6,000 to $10,000 per property, maybe even more. Appraisals, all those type of fees that actually get charged to the deal. All right, an asset management fee. This typically is between 1% to 2% of the deal. Now, it could be charged based on the gross income of the property or based on capital invested. So that's where you, as a limited partner investor, need to make sure that you understand which is it, how is it actually being charged, because that could impact your net return. Now, if the general partner is putting out a pro forma showing you returns net of all fees, I would still dig a little bit further and just understand how that fee is being calculated. Again, this is, to have somebody on staff reimburse their time and expenses to continue to monitor the portfolio, work with property management, for them to put their time and effort to do that. Another fee that you might encounter is what we call a construction management fee. And this is typically charged at about 5% to 10% of the total planned construction budget. So this is really good, point to drive home here. If two things: one, you don't want to see 5% to 10% total being charged on the total capital raise going to construction. You just wanted to see it, what's the construction budget, and keep the construction fee contained to that. Okay, that is for the general partner to bring in their knowledge and expertise, and maybe other general contractors and stuff like that to manage the construction of the asset. Two, keep it on your radar. If you see a construction fee being charged to the deal and there's no construction, I would red flag that and go back to the operator and really dig into why they are charging a construction management fee if there is no actual construction happening on the property. Unfortunately, I've seen that as well. Other fees out there could be an equity placement fee, typically 1% to 2% of the total investor capitals. That I've seen that fee charged more in line with, say, like a fund or a fund of funds, not so much with a single asset entity or a portfolio investment. You could maybe encounter a loan fee. Again, this fee in the industry is typically 1 to 2% of the total loan amount. This would go to cover the general partnership, anything that they might need to secure the actual loan. This is different than, say, having a guarantor fee or a key partner fee, right? And this would just be for them to, go through all the underwriting process and submit documents and stuff like that. Not a very common fee that I see out there, but it can, you might see in some deals. You could expect to see a refinance fee. So if there's, and sometimes these get lumped in as what we call a capital event fee. So if there perhaps is a refinance fee or a disposition fee, it typically is 1 to 2% of either the total refinance loan amount or 1 to 2% of the total sale price of the asset. And essentially that allows the general partnership to put their leverage their team, maybe offset some, the accountant, the broker, if there's anything that needs to go to the broker, draw up any legal paperwork in order to either refinance the asset or dispose of the asset. And then we already touched on it, but just to kind of put a neat little bow on this, you can also potentially encounter what we call, again, guarantor fee. It's typically to 1 to 2% of the total loan amount for a key partner to pledge assets to secure the loan. And this is one thing, I know some investors, they kind of balk at this, when they see a key partner fee. For me, I'm okay with it as long as the deal still works, because I don't have, the $80 million in liquid assets sometimes, or whatever is needed to secure that institutional grade asset. And, that can go to help incentivize bringing on a key partner so the loan can be closed. Now, what is fair? We talked about what we want to see in fees, how we want to create that transparency, alignment. We want to make sure we're not doing any mental gymnastics to try to figure out what our return is as a limited partner. We went through what fees can be charged. Now, this is certainly not an exhaustive list, but what's fair in a deal? Is it 0 fees, or can all the fees be charged? So what I have typically found is somewhere between 3 to 5, 4 to 5 fees are pretty typical standard deal to deal. And the ones that I typically see and pull out are deals that I go into are one where there's a clear acquisition fee, a clear asset management fee. If there's construction happening on the property, I think a construction fee is fair as long as it's contained to the construction budget only. A capital event fee, to either refinance the property or dispose of the property, sell the property. And then if a key partner is being brought in, if assets are needing to be pledged in order to secure the loan, then a guarantor fee. But again, just because the fees are there, especially on the construction and capital event, like a refinance fee or guarantor fee, I don't want them being charged to the deal unless certain things are actually happening within the deal. All right, guys, this is really quick. I wanted to make sure that I imparted, kind of end-to-end, demystification of what fees you could expect to see in a passive real estate deal, how you can still create alignment with you as a passive investor with the general partnership, even with these fees in place, and how that actually some of these fees actually would benefit you in the long run. If you are interested in learning more, be sure to join me at passiveinvestingwithwhitney.com. I got some free goodies there for you. And if you are here live, don't go anywhere.